Calculation of corporate tax due in a tax period. Introduction to corporate tax calculation. The amount of corporate tax due for a tax period is determined by applying the applicable corporate tax rate to the taxable person's taxable income for that specific period. This process is essential for businesses and entities operating under a tax jurisdiction, as it directly influences the amount of tax payable to the relevant tax authority. The calculation of corporate tax is a fundamental component of a company's financial obligations, and understanding the process ensures compliance with tax regulations. Corporate tax rate application. To calculate the amount of corporate tax that is due, the first step is to determine the taxable income of the taxable person, which could be a company, partnership, or other legal entities subject to corporate tax. The corporate tax rate is then applied to this amount. The corporate tax rate refers to the percentage set by the tax authorities that will be charged on the taxable income for the relevant tax period. This rate can vary depending on the country or jurisdiction, as well as the size of the business or industry-specific rules. Step-by-step process of corporate tax calculation. 1. Determine the taxable income. The taxable income is the total income of a company or entity, adjusted for allowable expenses, deductions, exemptions, and other adjustments according to tax laws. This includes both revenue generated from business operations and other sources, after subtracting eligible deductions such as operating expenses, depreciation, interest expenses, and tax losses carried forward from previous periods. 2. Identify the applicable corporate tax rate. Each jurisdiction sets its own corporate tax rate, which can either be a flat rate or a tiered rate depending on the size or type of the business. For example, small businesses may be eligible for a reduced tax rate or a tax exemption on part of their income, while larger corporations could face a higher rate. 3. Apply the corporate tax rate. Once the taxable income is determined, the applicable corporate tax rate is multiplied by the taxable income to calculate the amount of tax owed. This is typically a straightforward process. For instance, if the corporate tax rate is 10% and the taxable income for the period is AED 1 million, the corporate tax due would be AED 100,000, 1 million by 10%. 4. Final corporate tax due. The result from the multiplication of the taxable income and the corporate tax rate is the final amount of corporate tax that the taxable person must pay for that tax period. This is the figure that will be reported to the tax authorities, and the entity is required to settle this liability by the due date specified by the relevant tax authority. Example of corporate tax calculation. To further clarify the process, let's look at an example scenario. Company X, a UAE-based entity, has a taxable income of AED 5 million for the current tax period. The applicable corporate tax rate in the UAE is 9%, which applies to companies with taxable income above a certain threshold. For simplicity, assume no exemptions or deductions are available for this company. Taxable income, AED 5 million. Corporate tax rate, 9%. Now, applying the tax rate to the taxable income. Corporate tax due is equal to AED 5 million by 9%. Corporate tax due is equal to AED 450,000. Therefore, Company X will owe AED 450,000 in corporate tax for the tax period. This is the amount that must be reported to the tax authority and paid in accordance with the tax filing deadlines. Additional considerations in corporate tax calculation. While the basic calculation involves applying a tax rate to taxable income, there are several factors that can influence this process. 1. Deductions and exemptions. Some jurisdictions offer tax deductions or exemptions that can reduce the overall taxable income. These may include deductions for research and development, charitable donations, or investment in certain sectors. The availability of such deductions can result in a lower tax liability. 2. Tax loss carry-forward. If a company incurs losses in previous periods, these losses may be carried forward and offset against future taxable income, potentially reducing the amount of corporate tax due. This is an important feature for businesses with fluctuating profits, as it allows them to benefit from past losses. 3. Tax incentives for certain sectors. Many countries offer preferential tax rates or incentives for businesses operating in specific sectors such as technology, renewable energy, or manufacturing. Companies in these industries might benefit from reduced tax rates or exemptions on a portion of their income. 4. Tax audits and adjustments. The tax authorities may audit the financial records of a company to ensure that the tax calculation is accurate and that the appropriate tax rate is applied. Any discrepancies or non-compliance may result in adjustments to the tax liability and could lead to penalties or interest charges. For more details, contact us.